Welcome back to the channel. Shane Wallendorp from Orbis Investments recently wrote in First Links, the lower the starting price of an investment, the better it is likely to do, all else being equal. This sounds obvious. However, if I had $1 for every time I saw someone project the returns on their portfolio by the average of the past 10 years market returns, I would have fired a long time ago. So let's invert this statement. The higher the starting price of an investment, the worse it is likely to do, all else being equal. And this is what today's video is about: financial forecasting using a realistic rate of return. Please note the information on this YouTube channel and any links provided is for general information only. Please take the time to read my full disclaimer in the video notes. So this video probably won't be a popular one because the opinion is we should all be using a more realistic rate of return, read lower, when forecasting things like our fire date and drawdown calculations. Now, this doesn't necessarily mean using a negative rate of return, just a rate of return that is lower, much lower, than the current bull market that started after the GFC. And even though no one can predict the future, it is in our best interests to be on the right side of probabilities. And for me personally, as this bull market continues and will no doubt be the longest in history, the probability is it will end sooner rather than later. The data on this chart is for the S&P 500 index and is around 5 months old. However, it shows clearly the length of the current bull market at something like 3,500 days. And with respect to how rewarding the current bull market has been, it sits just below the bull market after the Great Depression, but still a bit behind the dot-com boom. So will we see a huge crash next year in 2022? Well, who knows? The answer is no one does. The esteemed economist John Maynard Keynes once said, "The market can stay irrational longer than you can remain solvent." We could still get 10 to 15% annual returns for the next several years, as the S&P 500 has since the global financial crisis. But our projections for things like when we expect to reach fire and how long our money will last are for the long run, and the probability is we will see lower returns than we're used to over the next 10 years or so. The point is simply to be realistic and not to base future growth on the annualized returns of the past 13 years. What growth might we see then? Well, here's an interesting graphic from Robert Shiller. This chart plots the average cyclically adjusted price to earnings, or CAPE ratio, for the US market over the past 140 years. Like standard PE ratio, the CAPE ratio attempts to inform us how cheap or expensive a particular market is. The long-term CAPE average for the US share market is around 17 times. The chart shows us there have been 3 periods over the past 140 years that the CAPE ratio for the US has exceeded 30 times. These being 1929, so the Great Depression, 2000, the dot-com crash, and right now, 2021. Basically, at 30 times earnings, investors have tended to say, no more, I no longer wish to buy the market if it's going to cost me 30 times current average earnings. And when things become this expensive, it does not take much at all for the house of cards to come tumbling down. In the 1929 and 2000 market crashes, the next 10 years returned miserly amounts. 1.7% per annum real return for the 10 years after 1929, and negative 2.6% real return for the 10 years after 2000. So this is pretty sobering stuff. And assuming the market does decline to the extent that the current bull market ends, what rate of return should we use? I think it would be wise to be quite conservative and use a real return closer to 4 to 5%. And even this may be too high based on what happened after 1929 and 2000. Personally, I'm currently using a real return of 2%. This is a 5% nominal return, less a 3% inflation rate. So assuming lower rates of return obviously has significant implications. Now, we all like to post on our Instagram feed stuff like the power of compounding and how long it would take someone to reach $1 million based on an X% rate of return. A common rate of return used is 10%. So allowing for inflation of, say, 3% to get a real return of 7%, we can see here it takes around 23 years to reach $1 million based on a $100,000 starting balance and a $10,000 investment each year. Change this to a real return of 2% and it takes twice as long at 47 years. But perhaps a 2% real return is too low and I'm just being too conservative. So here's some research you could use to come up with what you may think would be a fairer rate of return. A 2019 RBA paper authored by Thomas Matthews titled "The Australian Equity Market Over the Past Century" showed a 6% real return. This return is made up of appreciation of share prices and dividend payments. So anyway, call me the Grinch who stole Christmas, but seriously, playing the probabilities will serve you better than otherwise. Using a rate of return that is too high will just end in disappointment and perhaps even loss of motivation to reach your goals. For me, using a conservative rate of return implicitly provides a margin of safety, which means I have greater chance of my money not running out. Anyway, on that very, very positive note, Merry Christmas to everyone and wishing you a prosperous 2022. Thanks for watching and hope to see you soon.